G'day traders, Gavin McMaster here from Options Trading IQ. Today I just wanted to give you a quick video on put ratio spreads, which is a strategy I've been using with great success recently. So go into a lot of detail on how to trade put ratio spreads. Just quickly before we get started, just a reminder that anything discussed is for educational purposes only and is not a trade recommendation or investment advice, and no representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Alright, so when do we trade put ratio spreads? So I like to trade them when we've had a big move down in the stock. We're looking really oversold. You can see here this is US Steel, ticker symbol X. Massive gap down after earnings, and from there it's traded a little bit lower, but it's also gone more or less sideways over the course of a couple of months. So that's a perfect scenario for put ratio spreads. You do want it to go sort of sideways. The beauty with put ratio spreads is you can make money if the stock goes up, if it goes down, or if it goes sideways, just depending on the timing. Now, you don't want it to go too much further down early on in the trade. So you can see here, putting on the trade straight after the earnings gap down, the stock continued about 10% lower. A put ratio spread in that case was a little bit in a loss position at that stage, but it did recover, as we'll see shortly. So this is really a perfect scenario over a couple of months where we're trading sideways to slightly lower. So that's sort of what I'm looking for. Definitely, the risks are high when you've got a stock that's sort of gapped down like this. It's also below the 50 and 200 day moving averages. So there is a bit of cause for concern there, and you have to weigh that up as to whether you want to enter a trade like that. It is basically a neutral trade, but the biggest risk on the trade is a swift move down in the stock after you place the trade. So, potentially if you had waited in this example, for a week or two after the earnings gap down, that might have been an even better entry point. You can see RSI deeply oversold there for an extended period of time. But I'll show you how this trade worked out shortly. So just go through a few more examples. We've seen this happening a lot recently with big earnings gaps down and then sort of sideways to slightly lower over the course of a couple of months. So that's another perfect scenario there on Lulu. So you can see that the stock did continue a bit lower over a couple of months, but it did get a spike up to around 55. So it dropped to about 50 after earnings, spiked up to about 55 a couple of weeks later. That would have been a really good time to get out of the trade. But even so, holding the trade for longer, things probably still would have worked out quite well. Another one here, IBM. Again, it's an earnings gap down. And you just see it so many times, particularly recently. You get this gap down, you might see a little bit of further selling, but the stock kind of recovers, trades sideways over the course of a couple of months. So you can see here sideways to slightly higher over a couple of months. That's perfect as well for a put ratio spread. So really nice scenario and setup there on IBM. And another one, again, just seeing this sort of setup a lot recently. Target, massive gap down, volatility was quite high at the time, which is great for put ratio spreads. We continued a little bit lower over the next couple of weeks, but eventually sort of recovered once we, the earnings gap came down to about 57. A couple of months later, we're up at 58. I mean, that's perfect. And even so, drifting lower to about 54 a couple of months later, again, is also perfect because you've got this big profit zone below where the market's trading, and target moving into that as you get towards expiry is really good. So another quite similar setup there, really good setup that I look for on these trades. So the beauty with put ratio spreads is that we're taking advantage of the skew. So typically with put options, the further out of the money you go, the higher the implied volatility. That's because people are willing to pay more for crash protection. So you can see here just a standard option chain here on the Russell for July. At the money, put at 14.20 is low volatility. It's 12%. If we go further out of the money to 12.50, we're looking at 23%. So the beauty of put ratio spreads is we're buying those 14.20s, for example, and we're selling the 12.50s. Okay, so we're buying low, we're selling high. So just like a stock, you want to do the same with implied volatility. You want to buy low, sell high. So that's what we're able to do with these put ratio spreads. We're buying implied volatility at 12, we're selling implied volatility at 23. So that's a great advantage of put ratio spreads. Alright, so the trade on US Steel that I was talking about, here's the setup. So this was from back in May. We went out to July. Stock was trading at 22.32. We went and bought 10 of the 22 puts for $1.90, and we sold 20 of the $20 puts for $1.05. So you can see here there's some income potential in the trade. If the stock stays flat or goes higher, the solid line there is at expiration, we make a little bit of income, around 7% or so. The dashed lines there are the T plus 0 line and the T plus 42, so halfway to expiry. So you can see that, halfway to expiry, we can make money if the stock stays flat, goes up, or goes down, as long as it doesn't go down too much. The big risk in the trade is that the stock goes down straight away, as you can see in that T plus 0 line. If the stock goes down 10% the next day, we're down 15-20% on the trade. So that's the big risk. Looking at the Greeks, we've got positive delta, 127. So while it is kind of a neutral trade, it does start off with positive delta. But if we look at delta dollars, it's pretty minimal, only 2,800. So it's not a huge exposure. We're short Vega, we're long Theta, and the margin you can see there 2,994 for this trade. So if we can pull a little bit of income out of this trade, about $200 if we stay flat, that's a nice return on our 3,000 margin. Okay, so just under 10%. So you can see, the expiration graph, we can withhold a move 20% lower on the stock at expiration. So we've got a lot of room to move, again, as long as that move doesn't happen too early in the trade. Okay, so ideally, you want the stock to either stay flat or go up early in the trade. And then as you're getting close to expiry, you actually don't mind if it starts to drift a little bit lower. And perfect scenario is if it ends up, sort of around 7-8% lower in this case, when we're getting close to expiry, or maybe a week or two out from expiry, we're sort of in this zone here, which would be perfect. We can actually achieve significant profits and much higher than the actual income potential in the trade. Alright, so let's take a look at how the trade worked out. So we started this position on the 1st of May. The US Steel was trading at 21.94. And as we saw on the graph earlier, the stock continued to trade lower. So it actually went lower by about 11% up until the 18th of May. So the trade was under pressure. It was losing money. You can see here, 18th of May, the stock's down 11.25%. The ratio spread trade is down $530 or 17.7%. So, I typically have a 20% stop loss on these sort of trades. So we did get pretty close the day before, down 580, just under 20%. And from there, the stock started to recover and ended with, on the 13th of June, a $410 profit. So 13% return on the trade, whereas the stock's only gone up 1.3%. So really nice trade, and as you can see, we've actually made more money than the income potential on the trade. The income potential is only about 200. So as we've drifted just a little bit lower, we've got that increased yield or increased return in terms of dollars and percentage on the trade. So here you can see a graph of the performance of the trade. So this is our standard 1-to-2 ratio spread, and we'll look at a different variation after this. So blue line here is the price of the stock. You can see early on in the trade it's going lower, down a bit more than 10%. That's hurt the trade early on. The trade is losing more than the stock has gone down. So that's a bad scenario for a ratio spread. As you can see, we didn't quite hit our stop loss. As the stock has started to recover, the profits on the ratio spread have just increased very, very quickly. We're getting a lot of time decay. We're also into that profit zone. So really nice trade, ending with a 13% return in comparison to the negative about 3% return on the stock as of 19th of June. So that's a standard trade. You can also do a variation. You could do a 1x3. You can do any sort of variation that you can think of, really, and I discussed that in the blog post. So here, if we go for a 1x3 variation, we're still buying 10 of the $22 puts, but this time we're selling 30 of the $20 put. So it increases the risk on the trade significantly. We've got more negative puts. You can see we've got a higher margin requirement, as you would expect. We've got higher delta and delta dollars. All our Greeks are higher, basically. We've got higher vega. We've also got higher theta. We're picking up more time decay. And you can see the stark difference with this trade is that generally you're wanting the stock to go up. You can still potentially make money if the stock goes down a little bit. You haven't got quite as much margin for error on the downside. And also if the stock does fall early on in the trade, you're going to be under significant pressure because of those extra naked puts that you've got. Okay, so definitely a more bullish trade in this example. So let's take a look at how it worked out. Okay, so as you would expect, early on in the trade, as the price of the underlying is falling, this trade is coming under a lot more pressure than the standard variation. So 17th of May, the stock's down almost 11%, and the trade's down 1,600 or 28%. So we probably would have been stopped out at this point. Again, I tend to prefer the standard 1/2 ratio spread just because the risks are a little bit lower. So you can see here, quite a big loss early on in the trade. Now, if you had a stop loss of 30%, you would have stayed in the trade and the trade would have come back and would have ended up with a nice profit of $810 or about $450 by June 19th. So again, looking at a similar return percentage because we've got a higher margin. So around 13% again. And then by June 19th, the stock was down 3.7%. The trade was up 7.65. So, each to their own. You can do either variation. You can do a 2x5 as well. Whatever works for you. Obviously, you've got to be very careful with naked options and make sure you've got the right permissions. Make sure you understand the risks. If we get a big sell-off, those trades are going to cause you quite a few problems. So you've got to be willing to accept that risk and understand those risks. And so you can see this trade, a little bit more variation in P&L, higher profits, but in terms of percentage about the same. So again, I prefer the standard 1/2 ratio, but you can see how this trade worked out on a 1/3 ratio as well. So again, looking at the graph, you can see the price of US Steel dropping, and that has a really big impact on the ratio spread P&L early on in the trade. And then it does shoot back higher as the stock recovers, but as the stock continued down early on in the trade, that's what we don't want to see happen early on in the trade. We don't want the stock going down too much. This trade came under significant pressure, and whether you had a 20% stop loss or a 30% stop loss would determine whether you stayed in the trade or not. Alright, so another example on OIH this time. Again, standard 1/2 ratio spread. Stock was trading at 27.61. We're buying 10 of the $27 puts. We're selling 20 of the $26 puts. Again, you can see there T plus 20s halfway to expiry. We can make money if the stock stays flat, goes up or goes down. We've got a margin for error of about 6% on the downside halfway through the trade. But again, that T plus 0 line, if the stock goes down early on in the trade, it comes under pressure. So that's what we don't want early on in the trade. We've got positive delta again, similar delta dollar figure, about 2,500. And, similar Greeks in terms of gamma, vega, and theta. Margin's a little bit higher in this case, 4,300. So the income potential in the trade's a little bit lower, only about $100 or around 2%. So how did the trade work out? Well, the stock in this case was fairly flat to start with, which was quite good for the trade. We're sort of bouncing around zero, slight profit to start with for the first couple of weeks. Then 25th of May, the stock starts to decline, goes down 5-6%, but the ratio spread trade's actually staying in profit at this point, which is really interesting because we've gone through a lot of time in the trade, a lot of time decay starting to kick in, and we can withstand that down move a little bit better as the trade's progressing. So the highest the stock rose was 1.38% on 19th of May. Ratio spread P&L was 1.85% at the time. Now the stock at its lowest point was 8.91%. The ratio spread trade, the lowest P&L was the day before, a slight negative return. But you can see here that by the end of the trade, 16th of June, the trade's up $630, 15% return, and the stock was down 7.6%. So you can see the trades can make money if the stock goes down, as long as it doesn't happen too quickly. So in this case, a little bit different to the US Steel example. We're bouncing around zero to start with, and never really went into much of a loss situation, and then the profits start to really kick in later on in the trade. Okay, so here you can see the price of the underlying bounces around zero to start with, fairly flat. That's sort of helping our profit. We're staying above zero, and then as the trade progresses, the ratio spread P&L starts to really kick in, even though the stock's declining. So really good example there of how you can make money on these trades if the stock declines, as long as it happens fairly close to expiry and not early on in the trade. Alright, so what can we learn about put ratio spreads? We know they're a powerful strategy that have the potential to profit in up, down and sideways markets. The big risk in the trade is the stock making a sharp move lower early in the trade due to the naked put embedded in the trade. A 1:2 ratio spread is the standard setup, but it can be set up with other ratios such as a 1:3 in order to take a more directional exposure. However, risks on the downside are higher due to the additional naked put. From the two 1:2 ratio spread examples, we saw that the ratio spread followed the stock price. So early on in the trade, it tended to mirror the movement in the stock. And then as we got further along into the trade, it started to diverge a little bit. The profit on the put ratio spread started to rise, even though the stocks were falling. Alright guys, thanks for watching. I hope you enjoyed that. Make sure you check out optionstradingiq.com for more free content. Got lots of information there on iron condors, butterflies and other options strategies. So I'll be posting more videos shortly, and also more information on put ratio spreads. I hope you enjoyed it. Give the video a like if you did. Let me know in the comments if you have any questions, and I'll be sure to get back to you. Cheers guys, have a great day.